Hi, thanks so much for joining in. You're watching the Mutual Fund Show on BQPrime, and my name is Alex Mathew. Multi-cap funds, that is the topic of the conversation today. Now, just a short while back, just a couple of years back, this was the largest or one of the largest categories in the mutual fund industry, in the equity segment. And that changed when the markets regulator came in and changed the definition of multi-cap funds. It stipulated that 25% of the assets under management in these funds has to go into each small cap, mid cap, and large cap. And the last 25% can be allocated as the fund manager sees fit. At the time, mutual fund houses were given the option of making those changes in their multi-cap schemes or to transition their existing schemes into what was called a flexi cap category. A lot of mutual fund houses chose to do the latter. Now, we're talking about multi-cap funds today because it so happens that Edelweiss Mutual Fund has a new fund offer, multi-cap fund, and we'd like to talk to them about it. Joining me is Radhika Gupta, the Managing Director and Chief Executive Officer of Edelweiss MF, and Trideep Bhattacharya, the CIO of Edelweiss MF. Thank you so much for taking the time. Let me ask the first and the most important question at this juncture to set the context also, is that you chose, as I said, to take the latter approach, which is to transition to the flexi cap. You have quite a few assets under that scheme. I guess to a certain extent, a lot of people felt at the time, Radhika, that the new norms as they were a little restrictive, which is why they moved to flexi cap. So why are we launching multi-cap now?
Sure. So thanks, Alex. Good to be here. So I think the history was a little bit old and more has happened in that history. Now, when we had the option, our fund was running as a flexi cap fund in nature. It was benchmarked to NSE 500. It had about 70 or 60% large cap exposure, the balance mid and small. We always focus on creating minimal disruption to existing investors. So we took our what was erstwhile multi-cap fund and made it a flexi cap fund because we didn't want to do unnecessary buying and selling of securities. We had a particular mandate and we migrated our fund. As far as launching a new fund is concerned, we are a little thoughtful and we don't launch NFOs just because the category has opened. We like to evaluate market conditions, we like to evaluate liquidity, and we like to evaluate our basket more completely. Now, I think a few years since this event has happened, one, our own equity capabilities and team has substantially expanded, and I think Trideep can talk about that. But I think the clear differentiation between both funds is available. SEBI has also got mandatory benchmarking on both schemes, and the current flexi cap schemes are benchmarked to NSE 500. NSE 500 is a benchmark with 75% large cap exposure, which means that your flexi cap fund is now going to run as a predominantly large cap funds, and really benchmarks govern how schemes are run. We feel that if you look at the structure of the Indian market today, really mid and small cap as a segment has expanded. In 20 years ago, the average size of a large cap company was 3,000 crores. Today, the average size of a small cap company is 12,000 crores. And if you really want to capture the best of India's opportunities, we do believe it can't be only large cap, because while banking and financial services leaders are present in large caps, many of the leaders in capital goods, in China plus one themes, in diagnostics and capital markets are present in mid and small cap. So the default portfolio has to now move to a blend of large, mid, and small. The multi-cap fund construct lets us do this. Its benchmark is a lot more aligned to equal participation across market caps. And that's why we felt it's a good time to launch. In addition, I think we do have the mid and small cap capability this fund requires.
Fantastic. Trideep, I'll come to you on this next question, because at a time when we're looking at tremendous flows into small cap and mid cap, because of the outperformance in the year-to-date period, there are some questions about whether or not the valuation picture is as attractive as it has been at the start. And I think that's a fair question to ask. You're launching the scheme at a time when that question is being asked more often than it has in past weeks. Is that going to pose a challenge for you?
In fact, I would turn it around and say that while we have a very successful mid and small cap fund with robust track record, and we have been strong proponents of mid and small cap investing over the last couple of years. Given where valuations are, given that we have seen already a 40 to 50% rally in mid and small caps, we think that the incremental money today should probably go into a balanced portfolio, balanced across large, mid, and small cap as a stocks. So when we at Edelweiss, we sat together to think what could be that alternative, and hence what NFO to come with, if we do come up with, rather than going with a thematic fund, we thought this is the best way to best solution for investors given where valuations are for mid and small caps, and as present as an alternative to investors overall. The other point I would say that after having seen a good amount of rally in mid and small caps, there are some pockets of irrational exuberance that are present in that segment. But that is not to say that mid and small caps as a space is uninvestable. In fact, if you ask me, we believe that this is India's decade, and over the next 4 or 5 years, once we navigate through this volatility, which includes national elections, this, that, the other, we think that the next 4 or 5 years, India could see a strong runway for growth, driven by various different factors. And to capture that, one needs to have exposure in mid and small caps. What we are saying though now is we need to be a little more selective, and hence a multi-cap portfolio or a multi-cap construct helps us do that in the context of a similar, in context of one portfolio. And hence we are kind of taking the multi-cap approach of investing for incremental money, and that's our suggestion for investors as well.
Okay, Radhika, in terms of the drawbacks of this particular category, and you mentioned the flexi cap tends to mirror the benchmark as well, and 75%, I think by and large, most mutual fund schemes in this category in flexi cap are above that 75% mark. The drawback as I see it, and correct me if I'm wrong, is that in the event of a downturn, because you are restricted in having to have 25% each in mid and small cap, the possibility of a drawdown in that situation would be quite significant. Is that something that you are, through your partners, distribution partners, educating people about? And is there a investor type that you think should look at this very closely?
So I think that I'll answer the second question first. I think this will be the default portfolio for the future, because to Trideep's point and my point earlier, if you look at the structure of the Indian economy, I think you need to capture opportunities across market cap. And we also as a house are a big believer in bundled solutions. You can't have mid and small cap exposure today. Markets change, then you do market timing. Firstly, it's very hard to do market timing. You switch to large cap, you pay a lot of tax, then you move to mid and small cap again. I think the power of having things in one solution is really underrated. We've seen that with the success of hybrid funds. We've seen that with the success of our own gold and silver fund. I think having a single solution is very powerful, in a world where you pay taxes and there are costs to rebalancing. So I think the product is really for everyone in that sense. It is your default equity allocator. If you want to call it dumb asset allocation, call it that. Now, as far as volatility is concerned, I think we intend to run this as a broadly 40% large cap, 30 mid, 30 small fund, which means 60% is mid and small cap exposure. And of course, we are making that fact amply clear. If we wanted to run one more large cap biased fund, there was frankly no need to launch that fund. Will the risk be a notch higher? Of course, it will be a notch higher than running a pure play large cap fund. Will the returns be a notch higher? I think the historical data suggests that the returns will also be a couple of notches higher. Interestingly, when we look at the data on a risk-adjusted return basis, I think multi-cap stacks up well. So, investors are being rewarded for the incremental risk that they're taking.
Fair point. I want to come to the nitty-gritties of Trideep, the selection and the thesis behind this particular scheme. And I think in a sense, it will reflect what is across your other portfolios as well. But as Radhika pointed out, certain allocations are possible because of the nature of this particular scheme. So would you be able to give me a sense of how the portfolio will reflect that? What will the contours be?
So I think overall, I would say that, if you look at a bit of an equity market outlook, is probably kind of will set the context, and hence the portfolio would be run the way it will be. And I would set the context as that if you look at the macro today, whether you look at global macro or local macro, punctuated by the fact that the 10-year bond yield in the United States have reached levels that reached in 2007, the weaker global recovery, etc. I think it makes sense to say that global and local macro is reasonably negative. And hence, the way we want to sort of run the multi-cap fund on an ongoing basis is basically focusing the portfolio on what I call as pockets of earnings resilience. These pockets of earnings resilience are selected on a bottom-up basis and basically presents itself, earnings tailwinds, which are more than just the normal ones. And what that means is, even in a tough macro environment, these are the areas where we will have limited earnings downgrades, if any, or in a positive macro environment, we could see, a better earnings upgrades to come through. This is what I would call as a, heads I win more, tails I lose less kind of a way of thinking. And based on this sort of construct, we've come about 5 areas of pockets of earnings resilience, which is what I would say about 70 to 75% of our fund will be oriented towards. These 5 areas are briefly, and we can go into details if needed. First, we are positive about CapEx as a theme. We think that we are in the middle of a manufacturing upcycle driven by private sector CapEx over the next 2 to 3 years. Second, we think that lending financials are in a good spot right now. I would call it going through a Goldilocks moment with both growth and asset quality in the right place where they should be. Third, we think that direct and indirect plays on real estate are a good place to be because real estate is in the middle of a 5 to 7 year upcycle. And we are somewhere in the middle, and there is some more room to go. The fourth and the fifth areas are more emerging, and hence a multi-cap construct helps us better. The fourth area is defense, where indigenization of defense is a decadal opportunity in front of Indian corporates, and we think particularly stocks in mid and small cap can capitalize on the same. And finally, EMS, electronic manufacturing systems, as a theme, in my opinion, is probably even a longer dated theme overall. The sector itself is growing at about 30-odd%. The point really here is that in these areas, there is something more going on than the normal business conditions. And we think a bottom-up portfolio constructed in and around these areas would actually kind of present to investors, a portfolio which is relatively insulated, but at the same time from macro, but at the same time is well-oriented towards growth, and valuations are still not excessive. Okay. So enough of a long-winded answer.
No, it wasn't. I think it perfectly answered my question. No, Trideep, don't worry about that. In fact, I have a follow-up to that, which is that in a lot of schemes that you see across the board, you see a very significant allocation to the financials because you try and play that CapEx story or even the consumption story through these entities, which are central to that. Is that going to be something that you could see in your portfolio as well? I'm talking about a third in some situations of the portfolio, and that I guess is reflective of the bank Nifty or rather the Nifty composition as well. But is that going to be your focus, or is it going to be manufacturing? Because I looked at the presentation which spoke about manufacturing being the big theme and PLI being opportunities that you see in that manufacturing space.
Exactly. So I think our overarching theme, if you were to look at where we are taking the alphabets, it will be higher in manufacturing than it is in financials. Financials today is a fairly broad construct, by the way. We have lending financials, we have non-lending financials in the form of capital market players, depositories, and a whole bunch of other players. So in that context, we are talking about a specific subsegment within financials, which is the lending financials, which we are positive on. Whereas in manufacturing, we are more broad-based, I would say, whether it's capital goods, whether it's construction, and also defense, it could be a subsector, if you can call it that way. So we are more broadly overweight manufacturing, underweight or selective in consumption. Our consumption-related bets are more oriented towards urban consumption bets. And in that context, financials would come second or third in areas that we are betting on, because we are betting on a sub-segment, which is lending financials. And it is, in a way, linked to the manufacturing as a theme, because manufacturing, as you know, needs capital creation. And as part of capital creation, you need credit growth. And credit growth is what banks provide. So it is linked in a way. but we want to capture that part of the financials rather than anything and everything that falls under that category.
Fantastic. So, Radhika, did you have a point to add?
Yeah, I wanted to make a tiny point. And I think one of the things that distinguishes multi-cap is that if you look at the large cap universe, the flexi cap universe, because of this NSE 500 benchmark, financials ends up being 35-40% of that benchmark, which is why, Alex, you see what you said, portfolios heavily dominated by financials. In a multi-cap construct, because the benchmark is a lot more spread across sectors, your sectoral split is a lot less concentrated. Trideep talked about what we will intend to do, but the portfolio structurally lets us be a lot less concentrated towards financials.
No, that's a fair point. Radhika, Trideep, thank you so much for joining in and for giving us that perspective. I'm sure our viewers have a much clearer concept of what to expect going forward.
Thanks for inviting us to the show. Thank you.
All right, so that was the management of Edelweiss MF speaking about the multi-cap fund that they are currently offering through an NFO. But let's talk about